Thank you, Shobji. Hello, everyone. Good morning. I hope you had a good sleep and you are all here for this continuing session from the yesterday's session. And we have discussed India's 20 government grants yesterday, and uh, thereafter we have started India's 102 share-based payments. Now we will cover the remaining portion of India's 102 today, and thereafter we will cover the India's 24 related party transactions. So that's the agenda for today. So let's begin with where we have left. Okay. So this was the question where we closed the session yesterday, and I was expecting that you must have tried this at home as a homework, which I have given to you yesterday. In case you have tried it, please let me know in the chat box. Just waiting for the response. In case anyone has tried this at home and want to share any challenge or doubt, query, else I can proceed and discuss this question and the solution along with. So basically, let's start with this question. So Tata Industries issued share-based option to one of its key managerial personnel, which can be exercised either in cash, equity, and it has following features, right? So number of cash settled shares is 74,000. Service condition is 3 years as per the terms. And option 2 is number of equity settled shares of the face value of ₹100 each is 90,000, right? So either they can take a cash for 74,000 or they can equity shares for 90,000. Conditions is again service condition is 3 years and restrictions to sell is any top up condition. After the shares are credited, they cannot sell within next 2 years, right? Fair values for next 2 years are given along with the fair value of the grant date, right? So these are the fair values which are given in the question. Now we need to pass the journal entries for this. How this needs to be recorded in books of accounts in year 1 and year 2. So that was the question. So let's quickly understand. So fair value of the share with restrictive clause is how much? 115, which is given in the question. Here it is. Right? Number of shares are given in the question already, 90,000. So fair value comes to 1 crore and 3,50,000 by simple multiplication of these two numbers. Then fair value of the share at the grant date is how much? 135. That is given in the question. Here it is. Right? Now, number of cash settled shares are how much? 74,000. So fair value comes 99 lakhs 90,000 by simple multiplication of this, right? Now, fair value of equity component in compound instrument is how much? A minus B, right? The same concept which we have applied in our yesterday's practical, right? So we need to compute the equity component in the compound instrument value, right? By deduction of the cash equity settled value from the cash settled value, right? Now, this is how these journal entries would be recorded. So in the year 2000, employee benefit expense account will be debited, right? By how much? 24 lakhs, 35 lakhs, 24,000 rupees. How this is computed? So we have equity value at 3,60,000 divided by 3, and we have the share based payment liability that is for cash settled 74,000 into 138 divided by 3, right? So these two amounts total up constitute the total expense for the year 2000, right? Then in year 2001, again, we will debit the employee benefit expense and credit the share based payment reserve and the liability for the cash settled option. So again, we will compute 3,60,000 divided by 3, right? Because this number is going to be constant. So we can simply divide it by 3. And for cash settled, we will revise the fair value. Now the fair value comes 140 into my 74,000 into my 2 by 3, right? The weight for the second year, and then minus the expense which has been recorded in the previous year, right? So this is how this amount is calculated. Total of these two amounts comes to the total employee benefit expense for the year, right? Then we will move in year 2002. Again, the same logic for equity component, the amount is constant. Again, 1,20,000. And for the cash settled, again, we will change the fair value and 3 by 3 minus the total amounts which are already recognized in year 1 and year 2, right? So by doing so, we will get the amount of expense for the third year, right? Now, total of these two amounts comes to the total employee benefit expense for the year, right? So entries are same. It's just a matter of fact that we need to focus on our calculations, right? And that we have learned in our yesterday's session. So I hope this concept is now very clear to everyone. If you have any doubts or queries, please let me know. Now, because there are two choices, either the cash alternative can be chosen or the equity alternative can be chosen. Now, we need to see how the settlement will happen. So if the cash alternative is chosen, then how the settlement will take place, and if the equity alternative is chosen, then how the settlement will take place. That's the next item which we need to understand. So in case option 1, the cash settlement alternative is chosen, right? In that case, we will debit the share based payment liability account which we have accrued over the period of 2 years, and we will credit the bank account or cash account, right? And the whole amount, whatever we have the liability outstanding, will be discharged. That is 147 is the fair value into a 74,000 number of instruments or number of shares, right? So this value would be discharged in cash, and whatever amount we had accumulated so far in share-based payment reserve equity, 3,60,000, that is 1,20,000 each year, right? For the 3 years, right? So 3,60,000 will straight away will be moved to the general reserve or the retained earnings upon this settlement, because we are not going to issue as such any shares now. So this is a general reserve now, right? Now, if the equity alternative is chosen, in that case, what will happen? We will discharge the share-based payment liability again by the same amount, and we will issue the share capital in this case. How many shares we need to issue? 90,000 of 100 each. So share capital account will be credited by 90,000 into my 100, right? So that comes to 90 lakhs, and remaining portion will go to the securities premium, right? Because that is all premium on the issuance of the shares, right? And then whatever 3,60,000 accumulated balance we have in our share-based payment reserve account, that will also be credited to the securities premium account, right? In this case, because we are issuing shares, and that amount which we had accrued in the share-based payment reserve belongs to the securities premium account only, right? So this is how the settlement entries would be passed. So this is the accounting entries for year one, year two, and year three for the expense. And this is how the settlement will take place, because at the time of the settlement, we know how we are going to settle. So either this accounting or this accounting will be done basis on the alternative chosen. I'm happy to take your queries, doubts, if any. Please ping me in the chat box or in the query box. Okay. So if there are no queries, then I can proceed. So the next topic for the day is the modification. So sometimes it happens that whenever companies, uh, chart out any employee stock option plans, right? So 1 year down the line, 2 years down the line, they may do some modifications into that plan, right? Either by, adjusting the exercise price or by adjusting the number of shares, which will eventually be credited, right? So whatever adjustments they do, those on the date of the adjustment, or as per the standard we call it modification. So on the date of modification, some accounting gets triggered, right? Now, so modification accounting, uh, we need to understand. So modification can be of two types. Either the modification is for the benefit of employees, or the modification is not beneficial to the employee, right? So if company reduces the exercise price of the stock options, right, then in that case it is beneficial to the employee. Or if company increases the number of shares which will be credited to the employee, then it is beneficial to the employee, and vice versa, it is not beneficial to the employee, right? Now, as per the standard, if anything is beneficial to the employee because of this modification. For example, increase in the fair value of the equity instruments granted, or increase in the number of equity instruments granted, or any of the vesting conditions are modified for the benefit of employees, then all these are to be accounted for prospectively from the date of the modification, right? So as and when the modification gets implemented on the date, on the very same date, these additional benefit which will be passed on to the employee over the next remaining period will started accruing as an employee benefit expense, right? So if the modification results into benefit to the employee, it means additional cost on the part of the company, right? Because employees are getting benefit, so company will be incurring certain additional cost. So those additional costs now will start accruing from the date of the modification till the plan end date, right? For the remaining period. So all this accounting has to be done prospectively only, right? And if the modification is not beneficial to the employee, right? For example, decrease in the fair value of the equity instruments, decrease in the number of equity instruments, or any change in any of the vesting conditions which are, detriment to the interest of the employees, then we will straight away ignore and we will not do as such any accounting over here, right? So accounting gets triggered only if the modification results into any benefit to the employee, right? So let's do this question quickly to understand the concept better. So on 1st of January 2005, entity A grants an award of 1,000 options to each of its 60 employees on condition to remain in employment for 3 years. The grant date fair value of each option is 5, right? So 5 rupees is the fair value of each option on the grant date, right? And 3 years is the vesting period, and 1,000 is the number of options which will eventually be awarded to those employees who remain in employment, right? And on the date of the grant, there are only 60 employees with the company, right? So this is the basic information. Then at the end of 2005, entities A's share price dropped. So as on 1st of January 2006, management chose to reduce the exercise price of the options. At the date of the repricing, the fair value of each original share options granted was 1 and the fair value of each repriced option was on 3 rupees, right? So initially on the grant date, the fair value of each option is rupees 5. But on 31st December 2005, when the management revised or did the modifications to the plan, on that date, the fair value of original option is, decreased from 5 to how much? 3, right? And because it is decreased, so management has revised or modified the plan to provide additional benefits to the employee, and it has, given additional option having a, it has reduced the exercise price, resulting into change in the fair value of the repriced option from 1 to 3, right? So 2 rupees is the benefit which will eventually be passed on to the employee, right? By this modification. At the date of the award, management estimated that 10% of the employees would leave the entity before the end of 3 years. That is 54 awards would eventually vest, right? So 60 minus 10%, 60 minus 6, 54. During 2006, it became apparent that the fewer employees than expected were leaving. So management revised its estimate of the number of leavers to only 5%. So 57 awards would vest. And by the end of the final year, that is 2007, finally 55 awards have actually vested, right? So this is the question. In case you want to try, I can wait for you to pick it up first and come up with your answers. Okay. So I think we can discuss the solution because of paucity of time. So by 31st December 2005, how many employees are expected to be remain by the end of the third year? 54 employees given in the question. 1,000 is the number of options. 5 is the fair value and 1 by 3 is the weight for the first year, right? So the cumulative expense comes to 90,000 by the calculation, and this would be the expense for the year 1, right? Now, on 31st December 2006, option plan is already modified, right? So my original option plan was 57 employees would remain in the service because the change in estimate, management has changed the estimate of number of employees in the year 2. 1,000 is the number of options, 5 was the fair value, and 2 by 3 is the weight. So cumulative expense, we will calculate minus 90,000 we will do. But because of modification, companies passing on additional benefits to the employees. So we will calculate the expense for this additional modification benefit as well, right? So 57 is the number of employees, 1000 is the number of options, 2 is the fair value which will be beneficial to the employee, right? And into my 1 by 2, because now the remaining period is 2 years only. So 1 by 2 would be the weight for this modification accounting, right? So total of these two line items comes to 2,47,000 and 90,000 we have already accrued in year one. So 1,57,000 would be the remaining expense which we need to accrue. Now, for the third year, again, 55 is the now final number of employees, 1000 is the number of options, 5 is the fair value, and into my 3 by 3 is the weight, right? And 55 is the number of employees, 1000 is the number of options, and 2 is the fair value. Into my 2 by 2 is the weight, right? So 3,85,000 is the total amount which ideally should reflect in my P&L. Out of that, I have already recorded 2,47,000 in the previous 2 years cumulatively. So 1,38,000 is the amount of the expense which will hit to the P&L for the third year. Right. So this is how we need to do the calculations. Right. So please be mindful. If the modification is beneficial, then that expense will be recorded additionally, prospectively from the date of the modification, right? It will not impact my original expense account had the modification was done or not done, right? So irrespective of the fact whether the modification was there or modification was not there, my original plan expense will continue to be recorded or accrued the same way, right? It will not be impacted. On the top of that, additional expense because of this beneficial modification to employees will be recorded, right? So both the expenses will be recorded. I hope the concept is clear to everyone. Is that clear? Okay. So one more question we will practice on this so that we are very much clear with the concept. Marathon Inc. issued 150 share options to each of its 1000 employees subject to the service of condition of 3 years. The fair value of option given was calculated at rupees 129. Below are the details and activities related to the share-based payment plan. Now, 35 employees left in year one, and further 60 employees are expected to leave. Share options repriced because of market value of shares has fallen to rupees 50, right? So the fair value is fell to 50. After the repricing, they now worth rupees 80. Hence, the expense is expected to increase by rupees 30 on the part of the company, right? So because the share price has fallen in the market, so option is modified. Option plan is modified, resulting into 30 rupees additional cost, which will hit to the company because of this modification, because this modification is beneficial to the employee, right? So that is given in the question. Now in year two, 30 employees left and further 36 employees are expected to leave. And finally, in year three, 39 employees left. How the modification or repricing will be accounted for in the books of accounts? That's the question. So straight away, the question belongs to modification, right? Let's see how the calculations needs to be performed here. So the repricing was done at the end of the year one, and hence the increased expense would be spread over the next 2 years equally prospectively. Right? So total increased value due to modification is how much? 30 rupees. So 1/2 weight for each year will be applied, right? So number of employees 1000, employees left in the year one is 35 and expected to leave 60. So finally, net number of employees which will eventually be expected to receive the award is 905, right? For year two, the employees left already is 65 and expected to leave is 36, right? So 899 is the number of employees which will eventually be getting the awards. Option per employee is how much? 150 options to each employee, and 129 is the fair value initially when the plan was issued, right? And period weight is how much? 1/3 and 2/3 for year one and year two, right? Similarly, for year three, it will be 3/3. Now, in year two, we are getting the modification, and that will result into additional 30 rupees expense on the part of the company, right? So expense original, first of all, we will calculate. So this will be the original expense and modification expense is nil, right? In year two, because of modification, additional expense line item will come into play. And how that is calculated? That is calculated as 899 into my 150 into my 30 rupees into my 1/2, right? And here again, 896 into my 150 into my 30 into my 2/2 minus originally recognized, right? So this is how the modification expense will be recorded. Normal expense, we already know how this that needs to be calculated. So my original expense will continue to be accrued and recorded in the same way whether the modification was done or not done, right? So that will have modification will have no impact at all on my original expense. Only if modification is beneficial to the employee, then additional expense gets triggered, which will be recorded on the top of original expense, right? So please do not mistake or get confused that my original plan expense amortization will get impacted anyway, right? So that will continue to the same way. Only additionally modification expense will be triggered and recorded, right? Let me know if you have any queries, doubts over here on this concept or the way we are doing the calculations. I'm just waiting for your response. So if no queries, maybe that is an indication that I can proceed with. Okay, so the next important concept is cancellation and settlements. Now, again, the way we have treated the modifications, right? So modification accounting was like, if modification is beneficial to the employee, then additional expense will be recorded, but original expense will continue the way it was, recorded had the modification been done or not done, right? Now, in the cancellation and settlements, what will happen if the plan instead of modification is getting cancelled or settled with the employee, right? So if the plan was issued, say, for 3 years, and by the end of year one, company comes back and says that we are canceling this plan and nobody will get anything, right? So what do you think? What should be the accounting on this cancellation? Or if the company wants to settle by giving some cash or shares by the end of the year one for a 3-year plan, then how that settlement will be recorded, right? So that's the concept which we need to understand now. So if the plan is cancelled, right, without any settlement. Then suppose in year one, by the end of the year one, plan is cancelled. Then on the date of the cancellation, the remaining portion of the expense, which otherwise would have been recorded in the year two and year three, will eventually be recorded in year one itself, right? So on cancellation, what actually happens, we need to accelerate the accrual of the expense, which otherwise would have been recorded over a period of 3 years, now will be recorded on the date of the cancellation itself, right? So all the remaining expense will be recorded upfront on the date of the cancellation, right? If it is a pure cancellation without any settlement. And if there is a settlement too, along with the cancellation, then cancellation will anyway be accounted for the way it is to be done. And whatever we are paying cash to the employee, that is payment to employee, that payment will also be recorded over and above to the cancellation expense. So if the payment is greater than the fair value of the equity instruments granted, then excess shall be expensed additionally, right? So let's understand this concept with the help of this practical question so that we understand better how it is going to impact our books of accounts. Anara Fertilizers Limited issued 2,000 share options to its 10 directors. For an exercise price of ₹100, the directors are required to stay with the company for next 3 years, right? So 10 is the number of employee, 2,000 is the number of shares to each employee, and 100 is the now fair value of the option estimated on the date of the grant is how much? ₹130 per option. Expected number of directors to vest the option is 8. So out of 10 directors, it is expected only 8 will continue by the end of the 3 years, right? That is the management estimate. During the year 2, there was a crisis in the company and management decided to cancel the scheme immediately. And it was estimated further as below. Fair value of the option at the time of cancellation was how much? ₹90. And market price of the share at the date of the cancellation is 99. There was a compensation which was paid to directors, and only 9 directors were currently in employment at the time of the cancellation of such a scheme. It was agreed to pay an amount of ₹95 per option to each of the 9 directors. So ₹95 is being paid to each of these 9 directors who are there with the company on the date of the cancellation as a part of settlement because of this cancellation of the employee stock option plan, right? So these are the facts of the question. So there were all in all 10 directors, 2,000 shares would have been granted to them had they stay with the company for next 3 years, right? Exercise price is ₹100 per option. Fair value of the option on the date of the grant is 130. Expected number of directors which will eventually be there by the end of the 3 years is 8. During the year 2, because of certain crisis in the company, management decided to cancel the plan immediately and estimates that fair value of the option at the time of the cancellation is 90 and the market price of the share is 99. That is the given information. Now, compensation to 9 directors on the date of cancellation who are with the company are paid ₹95 for each option by the company. Now, tell me how this cancellation will be accounted for. Okay. So in year 1, expected number of directors is 8, but in year 2, 9 is the actual number of directors who are staying with the company. Fair value on the grant date is same because it is an equity settled plan. Number of option is 2,000. So the total amount comes to 20,80,000 into my 1/3 weight. So 6,93,333 rupees would be the expense amount for the year 1, right? And for year 2, we will calculate the amount of expense like this and deduct this amount from this, and we will get to this number for the expense amount which will eventually be recorded in year 2, right? So all the remaining amount is to be recorded in year 2 because the plan is cancelled. Otherwise, what would have been done? This amount into my 2/3 weight would have been applied. Then this amount would have been deducted and remaining amount would have been recorded here. And then in year 3, weight 3/3 must have been applied and this amount would have been deducted for year 1 and year 2, and the balance would have been recorded in year 3. But because we are not going to year 3, we are canceling the plan in year 2 itself. So all the balance amount we will record in year 2 itself, right? So we will not apply the weight of 2 by 3 anymore over here, right? Now, because of this cancellation, additionally 95 rupees have been paid, right, to 9 directors for 2000 options, right? So 9 into my 95 into my 2000. So 17 lakh 10,000 is the amount, right? So 17 lakh 10,000 is the cancellation compensation, which will be paid. Now, total amount which will be recorded in the P&L would be total cancellation compensation 17 lakh 10,000 less to deduct from equity 16 lakh 20,000. How this 16 lakh 20,000 is calculated? 9 directors, 90 rupees is the fair value of the option at the date of the cancellation. 2,000 is the number of options. So 16 lakh 20,000 is the total value which will eventually be deducted. So this 16 lakh 20,000 will be deducted from 17 lakh 10,000 and balance 90,000, because this is the additional amount which will be recorded in the P&L because of this settlement, right? These entries would be passed. So in year 1, employee benefit expense to equity 693. In year 2, employee benefit expense to equity 16,46,667. This amount is already calculated here, right? Here it is, right? So year 1, year 2 expense will be recorded, and then we will record the settlement. So we will additionally record 90,000 as expense, and equity will be debited by 16 lakh 20,000 and cash will be credited by 17 lakh 10,000. 17 lakh 10,000 is the cash payment which is made to the all 9 directors. 9 directors, 95 rupees into my 2,000, 17 lakh 10,000. This is the cash payment which will happen to the directors. So that's why cash account is credited, or the bank account is credited by this amount, and equity is debited by 1620 as we computed in the working note, and the balancing figure 90,000 will hit to the P&L because of this settlement. So this amount will be regarded as settlement expense, right? Incremental settlement is recognized as an expense, right? I hope the concept is clear and the calculations as well. Any doubts? I'm just waiting for your response for next 30 seconds. In case you have any queries, please do ask in the chat box. Okay, so if there are no queries, I can proceed with the next concept. So group share-based payment plans. So this is the next concept, group share-based payment plans. What does that mean? So as of now, we have understood what share-based payment plan is, right? So share-based payment plan is either equity settled share-based payment plan or cash settled or with cash alternative, right? All the three share-based payment plans we have discussed. We have done a lot of practicals around that, and we know how the expense needs to be recorded, right? Now, what if suppose holding company H Limited has a subsidiary S Limited right? S Limited, and it has employees, S Limited, right? What if instead of S Limited issuing the plan, H Limited issues the plan for the employees of subsidiary, right? Right? So if that is the case, then who will record all these expense? Subsidiary or the holding or both? What would be your thought on this? Right? It is possible or not? Yes, in practical life, it is possible. Holding company may come up with the ESOP plan for all its subsidiaries, employees, as well as for its own employees, right? So that plan is standardized for each of the employee working with that group. For example, Tata Group. Tata Group is a very large group having different companies: Tata Consultancy, Tata Motors, Tata Steel, Tata Tea, Tata Coffee, Tata Telecommunications, right? Now, if each of these companies, give a different ESOP plan, so they might, not be very much convincing to the employees. So few of the employees might be getting better plans than other employees having, employment with the same group, right? So to mitigate this issue, so that all employees are ranked at par in terms of their employee stock option plans, a group company, say Tata Sons, or any company within the group, say Tata Steel, comes up with the ESOP standard ESOP plan for all the Tata Group companies' employees. In that case, how the accounting needs to be done within that group, right? So that is called group share-based payment plans, where entire group is getting the same standard plan for all the group company employees, right? Holding as well as the subsidiary as well as the fellow subsidiary. Now, in that case, who will record all these expenses? Whether the subsidiary whose employees are given the benefits will record, or whether the holding company or any other fellow subsidiary who is issuing this plan will record the expense, or both the companies will record the expense, right? Or whether it will be recorded only in their standalone financial statements and not in the consolidated, or whether it will be recorded in the consolidated financials too, right? So that's the topic arises because of this group share-based payment plans, right? So let's understand with these simplistic examples in the form of charts. So group share-based payment plans, when shares are being granted. So this is going to be equity settled because shares are being granted, not the cash, right? So equity settled is the plan. Now, this is the parent company, this is the subsidiary company, and parent's equity shares are granted by the parent. So parent is coming up with the ESOP plan for the employees of the subsidiary company, and it is going to issue its own shares to the employees of the subsidiary, right? So parents' equity shares will be granted by the parent, right? So that is the scenario one. In this case, subsidiary company whose employees is getting this plan, subsidiary's separate financial statement, it will be recorded as equity settled plan. Then in parent P's separate FS, it will be recorded as equity settled plan. And then parent P's consolidated financial statement also, it will be recorded as equity settled. So because employees belongs to the subsidiary and plan is issued by the parent, share as per the plan, shares of the parent company will be issued by the parent to the employees of the subsidiary. That is the scenario one, right? So in this scenario, subsidiary will record this plan as equity settled, parent will record in its separate financial as equity settled, and parent will record this plan as equity settled in their consolidated financials as well, right? So that is the scenario one. Scenario two, when shares are issued, so again, it is going to be equity settled, but subsidiaries equity shares will be granted by the parent. So in the scenario one, parent company was granting the plan and parent company was issuing its own equity shares. Now in second case, parent company is granting the plan, but issuing the equity shares of the subsidiary company rather than its own shares, right? So in this case, subsidiary company separate financial statement, it will be equity settled. Parent company separate financial statement, it will be cash settled. Why? Because parent company is not issuing its own equity shares, but parent company is purchasing the equity shares of the subsidiary company from the market and granting them to the employees. So parent company eventually discharging it as a cash settled only, because they will be purchasing the shares from the market for the settlement or transfer to the employees under the plan. So they will be incurring the cost in cash, right? So they have to pay cash in the market to buy the shares and then grant those shares to the employees. So that's why it will be regarded as cash settled for the parent company. And then in the piece consolidated, because this is one single legal entity now, right? So piece consolidated financial statement, it will be regarded as equity settled only, right? For group, it will be equity settled in this case, right? So let's explore scenario 3. Scenario 3 is again when the shares are granted, that is, it is going to be equity settled, right? But in this case, what is happening? Plan is granted by the subsidiary, but as per the plan, parents' equity shares will be granted. So in the subsidiary financial statements, it will be cash settled, because now subsidiary is giving the plan, but subsidiary will be offering the parent company shares. So subsidiary cannot issue parent shares, right? So subsidiary has to buy the shares from the market, right? And then grant them to the employees. Hence, in this case, it will be regarded as cash settled for the subsidiary company, because parent company is not granting the plan. So in the parent company's financial statement, there will be no accounting. And in these parent company consolidated financial statements, it will be regarded as equity settled, because groups financial statements, groups shares are being issued, right? So parents company is the group company, group parent. So group is issuing the group shares, right? So that's why it is equity settled in that case. Now, scenario 4, when the shares are being granted, but whose shares? Subsidiaries equity shares are granted by the subsidiary, right? So plan is given by subsidiary and shares of subsidiary are granted. So in this case, what will happen? In subsidiary as a FS, it will be all equity settled, because subsidiary is going to issue its own equity shares. In parent, there will be no accounting, and in group, it will be equity settled again, because group is issuing its own shares, right? So this is how the 4 scenarios plays out in this case. Now we will move to the cash settlement. So when the plan is a cash settled option, right, where cash will be granted rather than issuing the shares. Now, scenario 1, based on parents' equity shares, cash will be granted by the parent. So parent is issuing the plan and parent will be discharging the cash basis on the parent's equity. So in separate financial statement of subsidiary, it will all be equity settled, because subsidiary is neither granting the plan nor settling the plan, right? So it will be all equity settled, because employees belongs to subsidiary. That's why in subsidiaries books, it will be equity settled only. In parents P, separate financial statement, it will be cash settled, because parent is giving the plan and will be settling this in the cash, right? And in the consolidated as well, it will be cash settled, because parent is settling the plan in cash with the employees, right? Now, scenario 2, when cash will be settled by the parent, but basis on the share value of the subsidiary shares rather than the parent. In that case, again, subsidiary will account for it for as equity and parent will account it for as cash settled, because parent is going to settle it in cash with the employees, right? Scenario 3, when group share based plans, when cash is being settled, so based on the parent's value, parent shares value, but to be granted by subsidiary, because now subsidiary is going to settle it. So subsidiary will treat it as cash settled in its own financial. Parent have no accounting implication, because parent is not involved at all. And in the group financial, it will be again cash settled, because it is being settled in cash. And lastly, when subsidiary is going to settle basis on the subsidiary's equity share value, right? So in this case, subsidiary and the consolidated both will be account for it as cash settled, and parent is not involved in this plan, so no accounting triggers in the books of the parent company. So that's how All in all, 8 scenarios are formed. All the 8 scenarios I have discussed, 4 scenarios related to the equity settlement, 4 scenarios related to the cash settlement. You just need to master this concept so that you are not confused in whose books it will be equity settled or in whose books it will be cash settled, right? Let's do one practical to understand this better. A parent grants 200 share options to each of the 100 employees. So who is granting? Parent. Or whose employees? Of its subsidiary. Conditional upon the completion of 2 years of service with the subsidiary, the fair value of the share options on the grant date is rupees 30 each. Right? At the grant date, the subsidiary estimates 80% of the employees will complete the 2 year service period. This estimate does not change during the vesting period. At the end of the vesting period, 81 employees complete the required 2 years of the service. The parent does not require the subsidiary to pay for the shares needed to settle the grant of the share options, pass the necessary journal entries to record this arrangement. In case you want to try, I can wait for 30 seconds, 60 seconds, so that you have opportunity to test your knowledge. Okay, so let's discuss the solution. See, we will record the employee benefit expense or the remuneration expense by whatever name we want to call it, debit to the P&L. Now, how many employees are there? 100 employees in year one. 200 is the number of options, 30 is the fair value, 80% is the expectation that the employees will remain, and 1/2 is the weight, right? So 2,40,000 would be the amount for the year one expense, and 200 into my 81 employees, finally the number arrived, and 30 is the fair value and minus 2,40,000, which is already recorded. So 246 is the amount of expense for the year two, right? So this calculation is too simple by now, right? Now, the question arises, who is going to record these entries? So these entries will be recorded by subsidiary company, right? Why so? Because parent has granted this plan to the employees of the subsidiary, where the settlement will take place by issuing equity shares, right? So subsidiary will record it as a equity settled plan in its books, and this is the literature behind this as per the standard, as required paragraph B53 of the Ind AS 102. Over the 2 year vesting period, the subsidiary measures the service received from the employees in accordance with the requirements applicable to the equity settled share-based payment transaction as given in the paragraph 43B. Thus, the subsidiary measures the services received from the employees on the basis of the fair value of the share options at the grant date. An increase in equity is recognized as a contribution from the parent in the separate or individual financial statements of the subsidiary, right? So this will be treated as a contribution from the parent company. So subsidiary will record the expense as equity settled. So this is the question I would like to give you in homework. So please mark this question as homework question, right, for you. Because concept I have already discussed, one practical we have already done on this. So This question is for you to pick up in homework. Now, I will move to the disclosures part of this standard. As you know, every Ind AS has its own specific disclosure requirements, and we need to make all these required disclosures in our financial statements mandatorily. We have no choice, right? So, what are those disclosures? So, we will tell what is the nature and extent of the plan, description of each of the scheme, and then we will provide a reconciliation from opening to the closing. That is, opening outstanding number of at the beginning, granted during the period, forfeited, exercise, outstanding, exercisable, right? And then valuation method used to value the fair value. In practical life, fair value measurements needs to be done by the fair valuation experts, right? So we need to tell which valuation method we have used to estimate the fair value of the awards and effect of expense on the entity's profit and loss. That is how much expense is recognized during the period because of these plans, right? So this is the sample disclosure. I have picked it from one of the listed companies published publicly available annual financial statements, annual report. So this is how they have disclosed. The following table provides an overview of all the existing share option plans of the company, right? So vesting period they have mentioned contractual terms they have mentioned equity settled scheme, scheme 1, scheme 2, 2005, plan name is 2006 plan, long term incentive LTI plan, 1 to 5 years, 1 to 3 years, 7 years is the contractual term, 7 years is the contractual term. The stock options vesting are subject to service and certain performance conditions, mainly pertaining to certain financial parameters. So financial parameters means like increase in revenue, increase in profits, etc. Right? Those are called non-market linked financial parameters. And this is how the reconciliation is produced. So for this plan, it has two schemes. So both the schemes are presented outstanding at the beginning, granted, exercise, outstanding at the year end, or exercisable. Similarly for the second plan. And this is how the tabular presentation for the current year and the preceding year is done. So this is how this disclosure needs to be captured in our financial statements, right? Then I will also provide what is my weighted average remaining contractual life for these plans. So remaining contractual life, fair value, and the share price options for both the years in the columnar format I need to disclose. And here the company has provided the range, right? Then lastly, what are the assumptions used by the in fair valuing using the Black-Scholes model, right? So company has disclosed the valuation method as Black-Scholes valuation method and the assumptions used, like what is the risk-free rate, what is the expected life, volatility, dividend yield, exercise price, and share price on the grant date, right? So all these disclosures are also made. Correct? So that was it on this standard in terms of accounting presentation and the disclosure piece. If you have any questions around this, please do ask me. I'm happy to take them up now. Okay, so if no questions or no queries, maybe I can quickly discuss the differences between the Ind AS and the IGAP, although there is no corresponding accounting standard in the IGAP available, but there is a specific guidance note available on the employee stock option plans, which you must have already studied and applied in your practical life in case you got a chance. So Ind AS 102 covers the share-based payment to employees, which is measured based on the grant date fair value of the equity instruments, right? So intrinsic value approach is permitted only in rare situations, right? Everything needs to be done at fair value. But as per the Indian GAAP, there is no accounting standard, but there is a guidance note, and that requires, employee stock option plans to be recorded at fair value or intrinsic value. So that is the choice available within that guidance note, whether you can record it at fair value or at intrinsic value, right? But under this Ind AS 102, fair value is the mandatory option unless and until we come back and say that we cannot determine the fair value, then only in very rare situation, intrinsic value accounting is allowed, right? Graded vesting, awards with graded vesting are measured in substance in multiple awards, so, right? So this will say these are multiple awards. And in case of, as per the guidance note, it will be amortized on a straight line basis, right? Under Ind AS and IFRS, that is IFRS 2, there is no gap differences. Everything is same. So let's try this MCQ quickly, and then we will take a break and start with the new session, a new chapter. So first MCQ is company B has approved a bonus plan for its employees as per which the amount of the bonus will depend on the price achieved at the end of the year as follows. If the share price is below 10, then the bonus amount is 0. If the share price is between 10 to 12, amount is itna. And if the share price is above 12, the amount of bonus is 1500. Whether the above arrangement will be within scope of Ind AS 102. That's the question. What do you think? So it is not a share-based payment plan. Why? Because this is a conditional upon the share price movements of the uh, company, right? So anything which is conditional upon the share price movements is not a share-based payment, right? Share-based payment plans are those who are based on the fair value of the shares. That whatever is the fair value of the shares, basis on that it will be discharged. But whether it will be discharged or not, or how much by what amount it will be discharged, depending on the fair value increase, market price increase or decrease of the shares, is not the share-based payment plan, right? MCQ 2. ABC Limited issues its shares to a law firm as a payment for legal service. Is this transaction within the scope of 102? So, lawyer's fees, instead of discharging in cash, is discharged by equity share. What do you think? Is this a share-based payment plan? Yes or no? Yes, it is a equity settled because lawyer firm is a third party vendor who has provided the services, right? And Ind AS 2, or sorry, Ind AS 102 covers both employees as well as third parties. Third question. A Limited issues stock appreciation rights SARs to its employees. The SARs requires company to pay employees an amount equal to the appreciation in the value of 1,000 shares of its stock over a period of 2 years. Is this transaction within the scope of 102? SARs, share appreciation rights, are being issued. Whether this is covered by 102 or not. Yes, because it is a cash settled. We have done the practical around this as well, if you remember in our yesterday's session, right? Next, ABC Limited issues share options to purchase company B shares, an unrelated public company, to its employees. Is this transaction within the scope of Ind AS 102? No, it is not a share-based payment transaction. Why so? Because ABC Limited issues share options to purchase company B shares, right? So, which is an unrelated company. That is not a company within the same group. So, if the company is outside the group, then it is not a share-based payment plan, right? ABC Limited enters into a forward contract to buy 1,000 units of a commodity at a price equal to 2,000 of the ABC's ordinary shares. ABC can settle the contract net, but does not intend to do so, nor does it have a practice of doing so. Is this a transaction within the scope of Ind AS 102? What do you think? Yes, since ABC does not have a practice of settling these contracts on a net basis and does not intend to do the net settlement. Hence, this is a contract as share-based payment because the payment will be happening basis on the value of the shares, right? ABC Limited has granted a right to its employees to receive cash payment equal to excess of the share price over rupees 20 multiplied by 2000. For example, if the share price is 30 at the end of the year, employee will receive uh, 20,000. This is subject to the employee continuing the employment for 3 years. Whether this is a share-based payment plan or arrangement under Ind AS 102. Yes, it is a cash settled share-based payment plan, right? Because cash is being settled basis on the fair value of the shares, right? Next, the conditions that determine whether the entity receives the service that entitle the other party to receive cash, other assets, or equity instrument of the entity under share-based payment arrangement is known as vesting conditions, right? Because vesting conditions determines the eligibility of the other party to receive the shares. Next, Ind AS 102 covers share-based payment transactions among the group entities. Which of the following statements are true or false? Number A, transfer of equity instruments of the undertaking's parent to parties that have supplied goods or services to the undertaking, and transfer of equity instruments of another undertaking in the same group as undertaking to parties that have supplied goods or services to the undertaking. So both A and B are true, or neither A and B are true. Neither A, or sorry, both A and B are true, right? Why? See, equity instruments are being transferred, right, among the same group entities, right? So within the group entities, one of the companies in equity instruments are being transferred to the supplier of the goods, right? So that is the share-based payment arrangement. So this is a practical question for your homework from your past examination. You can try it at your home because we have done already these type of questions in the classroom. So you can very well try this at home, right? So both these questions are at for your homework. So that was it from my side on this standard. In case you have any doubts or queries, I'm happy to answer. I'm waiting for 30 seconds for you to type your queries in your chat box. Okay, so no queries. So we can proceed with the break of 10 minutes. So we will resume by 8:20, right? So it is 8:10 by my clock. So by 8:20, I will resume. Let's have a break now. now, and we can start the session. I hope everybody is back. Please confirm me to. Okay. So let's start with India's 24 related party disclosures, right? So as such, there wouldn't be as such any accounting implications over here in this standard, and we don't need to do any calculations as well. We only need to understand who all parties would be identified as our related party and what all disclosures, if they are related party, then what all disclosures for any transactions which the entity has done with them needs to be disclosed and how, right? So that is the overall objective of this standard, that identification of the related parties, identification of the relation, nature of relationship, right? Then what are the related party transactions? What are the outstanding balances with those related parties at the year end? And if there are any commitments with those related parties, right? So that's all we need to discuss, understand in this standard. So the scope of the standard is identifying the related parties, identifying the related party transactions, then determining the accounting balances between an entity and its related parties, identifying any commitments, if there are any, between the entity and the related parties, and the circumstances in which the disclosure of above items are to be made in our financial statements, and determining what all disclosures are required, which we need to make in our financial statements. So that's the overall scope of this standard, right? Disclosures are to be made in standalone or individual financial statements as well as in the consolidated financial statements after elimination of intra-group related party transactions and outstanding balances while preparing the consolidated, right? So intra-group transactions and intra-group balances will be eliminated while preparation of the consolidated financial statements, right? And disclosures are not required when it would conflict with the reporting entity's duties of confidentiality or entities prohibited by any other statute, regulator, or other similar competent authority to disclose any particular information. For example, in case of banks, there might be some situation or circumstances under which banks are, not required to disclose a particular information if it is confidential, right? So that might be a situation. But because on banks, Ind AS is not yet applied, so hence we haven't seen as such any practical, you know, uh, example of this. Now, there is one exception to the above rule. If the above items occurred between the investment entity and subsidiaries which are measured at fair value, then these items are not eliminated while preparation of the consolidated financial under Ind AS 110. So that is the exception given in Ind AS 110 itself, right? Okay. So what are the key definitions? Key definitions are: a related party is either a individual, that is the person, or an entity that is related to the reporting entity by virtue of this standard definition, right? And what do we mean by reporting entity? Reporting entity is the entity that is preparing the financial statements, right? For whom we are going to determine whether a particular party is a related party or not, right? So that is the reporting entity for the purpose of this standard, right? Thus, two types of related party relationships are possible. Number one, between the reporting entity and the person, that is the individual, and between the reporting entity and another entity or entities, right? So because related party can be a person or related party can be a entity as well, right? So these are the definitions which we just need to quickly, revise. Control is defined in which standard? Ind AS 110, right? Consolidated financial statement. So control exists when a person or an investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee, right? So this is the definition given by Ind AS 110. Then there is a joint control defined under uh, Ind AS 111 joint arrangements. Joint control is a contractually agreed sharing of the control of an arrangement by the two parties or more parties, right? And significant influence is the power to participate in the financial and operating decisions of the investee, but is not the control defined under Ind AS 28, right? So these are the definitions which we are already aware of. Basis on this, we would be assessing whether a party is the related party or not, right? Now, key managerial personnel. This is one more definition given by the standard. So key management personnel means the persons who have the authority and responsibility for planning, directing, controlling the activities of the entity directly or indirectly, including any director, whether executive or not, right? So executive directors, EDs, and non-executive directors, right? Both are considered as KMP, right? As per Ind AS 24. In IGAP, non-executive directors are not considered as KMPs, right? Okay. Government definition, we already know. We studied it yesterday as well. Government refers to the government agencies, and similar bodies, local, national, or international, right? And government related entity is the entity that is controlled jointly or significantly influenced by the government. For example, RBI, CAG, etc., right? Okay. So that's all about the basic stuff of this standard. Now we will understand the relationships between the reporting entity and a person. So this is the section 1 where we are going to talk about the relationship with the individuals. Okay. Of the reporting entity, RP. Reporting entity is the entity who is preparing the financial statements under Ind AS. For this reporting entity, we are identifying those individuals who are related to the entity, right? So that's the relationship we are going to understand now. So person or a close member of that person's family is related to the reporting entity if that person has either the control, that is promoter, right? For example, or the joint control, that is the joint venturer, right? Over the reporting entity, right? For example, A Limited is the company and Mr. A is holding, say, 50% stake or 55% stake, right? So Mr. A controls A Limited. So Mr. A is a related party to A Limited, right? If Mr. A holds, say, 50% and Mr. B holds 50%, then Mr. A and Mr. B both are related parties to the A Limited, right? Because both are joint controllers of the entity, right? Or has a significant influence over the reporting entity. So if Mr. A instead of 50% has 20%, then it has SI over the A Limited. So it is a related party. Or is a member of key management personnel of the reporting entity or of the parent of the reporting entity. For example, A Limited is having a holding company H Limited, okay? And Mr. A is CFO in holding company. So Mr. A will be treated as KMP or related party for A Limited as well because he is the holding company CFO, right? So key managerial person, either of the reporting entity or of the parent of the reporting entity, both are considered as related parties, right? Now, close family members or close members of the family of a person are the ones who may be expected to influence or be influenced by that person in their dealings with the entity, right? For example, in our previous example, Mr. A was a related party, right? Mr. A was a related party, but what if Mr. A's children, Mr. A's spouse, or Mr. A's domestic partner, or Mr. A's brother, Mr. A's sister, Mr. A's father, and Mr. A's mother, right? So all these persons are also to be treated as related parties for A Limited because Mr. A's close family members are all these, right? Children of the person's spouse or the domestic partner, right? So because this concept has come from the West, so in the West, there are living relationships as well, right? Which are equivalent to spousal relationships, right? So because of the fact that those domestic partners do have the influence on the individual, so the children of the person's spouse and children of the person's domestic partner are also covered, right? And dependents of that person and the person's spouse or the domestic partner, right? So if there are any dependents of the Mr. A's spouse or Mr. A's domestic partner, those are also covered, right? So all these people who are part of the close member definition of, the main person who is actually having a control, a joint control or significant influence over an entity will all be regarded as related parties. So all these person will also be treated as related party for entity A Limited in case Mr. A has all these people as their close family members, right? So this is one of the example. Let's understand this. Mr. A holds 51% equity share capital of A Limited. A Limited has no other form of share capital. Mr. A controls A Limited. Hence, Mr. A is a related party. Mrs. A is the wife of Mr. A, is also a related party by virtue of being the spouse of Mr. A, right? Now, another example. Mr. D is a director of H Limited, being KMP of the H Limited. He is related to H Limited. S Limited is a subsidiary of H Limited. So Mr. D is also related to S Limited because Mr. H is the KMP of the holding company. So KMP of the reporting entity as well as KMP of the holding company, both are to be treated as related parties under this Ind AS. Although under ICAI, right, this relationship was not considered as the related party. So KMP of the holding company were not to be treated as a related parties for the reporting entity. But in Ind AS, KMPs of the holding company are also to be treated as a relating party, right? So let's do this example, whether A Limited, B Limited are related to each other. So Mr. X has investment in entity A and Mrs. Y, Miss Y, that is the domestic partner of Mr. X, has investment in entity B, right? Now, because Mr. X has significant influence only here and Miss Y has only significant influence here. So entity A and entity B are not to be treated as related to each other, right? But if Mr. X, instead of having significant influence, had control, oblique, joint control, then in that case, it would have been established as a related parties, right? So both the places, if only SI is there, right, then it will not be treated as related parties for entity A and B. But if either on one side control or JC exists and other side SI exists, or here control or joint control exists and here SI exists, then in that case A and B are related to each other. So that was it on the individual relationships. Now we will talk about the relationships between the reporting entity and other entities, right? So the entity and the reporting entity are members of the same group. For example, H Limited is the holding company, SA is the subsidiary, and SB is the subsidiary, right? So holding company and subsidiary are related party to each other. Yes. Holding company and subsidiary are related party to each other. Yes. And subsidiary, because of common parent are related party to each other? Yes, by virtue of clause A, right? So clause A is saying the entity and the reporting entity are members of the same group. That is, members of the same group, which means each parent subsidiary and fellow subsidiary is related to each other. So HSA are related, HSB are related, SASB are related, right? So all these entities are related parties to each other, right? So this is as per the clause A. Clause B, one entity is associate and or joint venture and other is an associate. So for example, H Limited is the holding company. H Limited has S1 as the subsidiary company, right? And S1 Limited has AS as the associate, right? Now, H Limited has another subsidiary S2, right? So this is subsidiary and this is subsidiary and this is associate, right? Now, you tell me whether AS Limited and S2 Limited are related. Yes, they are related because S1 is the subsidiary of H Limited common parent, S2 is the subsidiary of H Limited common parent. So S1 and S2 are related. So S1 associate is also related to the S2, right? Or if S1 had a JV, say JS, then this is also related to S2. So subsidiaries, associates, and subsidiaries joint ventures are related to the subsidiary, to the parent, and to the fellow subsidiaries, right? Is that clear? Any questions? Okay. Clause C. Both entities are joint ventures of the same third party. So, for example, H Limited has entered into a joint venture of JHA Limited with B Limited. So, A Limited is another company and B Limited is another company, right? And H Limited is one company. And they have formed a joint venture, JHA, right? And they have formed a JHB, right? So this is the JV and this is also a JV, right? Now, the question is whether these two JVs are related to each other. Answer is yes, right? In this case, what is happening? Joint venture has a common venturer, H Limited, JHA, and similarly, JHB also has a common venturer. So by having a common venturer, JHA and JHB are related to each other. Okay. Clause D. One entity is the joint venture of the third entity and other entity is an associate of the third entity. Now, in this case, what is happening? This is H Limited and they have formed an associate, AH. Okay. And they have formed a joint venture, JH. Okay. Now, question is whether this associate and this JV are related to each other. The answer is yes. Why? Because associate has a common company who has significant influence over it, and JH joint venture has a common venturer. So H Limited being having a SI over AS and having a joint control of JH. So these two parties are to be treated as related parties to each other, right? Clause E. The entity is a post-employment. Post-employment means gratuity trust, right? ESOP companies, ESOP plans, or any other long-term service award plans, post-employment benefit plans. All these plans, if are constituted through a separate entity or trust, then those trusts are to be treated as a related parties under the Ind AS and needs to be disclosed in the related party schedule, right? So all the post employment benefit plans, for example gratuity, pension, etc., are to be treated as a related party of the reporting entity and hence needs to be disclosed by the sponsoring employer company. Okay. Then clause F, the entity is controlled or jointly controlled by a person identified in one above. So this company is A Limited, right? And Mr. A is having a control of this, right? He also controls B Limited, right? So Mr. A being a common promoter or common controller of A Limited and B Limited. So A and B are related to each other. Clear? Okay. A person identified in 1A above has significance over the entity and KMP of the uh, member of the KMP of the entity or the parent entity, right? So here it is A Limited. Here it is Mr. A, right? Mr. A controls A Limited, right? And here it is B Limited. And Mr. A is a, say, non-executive director in B Limited. So A and B are related to each other. Why? Because A Limited is being controlled by Mr. A and Mr. A is the non-executive director, that is the KMP of B. So B Limited and A Limited are related to each other by virtue of clause G. Clause H. The entity or any member of the group of which it is part provides key managerial person services to the reporting entity or to the parent of the reporting entity. Let's understand with an example. So A Limited is a company having 3 subsidiaries, B, C, and D, right? And it also has an associate company, E, right? So this is associate, this is subsidiary, this is subsidiary, and this is subsidiary, right? Now, subsidiary F of E Limited. So E Limited has a subsidiary F, right? Provides key managerial personnel services to A Limited. This provides KMP services to A Limited. Then in that case, this F Limited is in related party with A, B, C, D, and E. So this F Limited will become the related party of E Limited, B Limited, C Limited, D Limited, and A Limited, right? So this will become the related party of all these companies by virtue of providing the KMP services to the A Limited, right? That is the clause. So we have understood by now all the clauses of this standard. Now we will apply this knowledge in some of the practical questions, right? Because the objective of these sessions is to, pick up the concept through practical questions more, right? R Limited has an associate B Limited. B Limited has a subsidiary S Limited and a joint venture J Limited and an associate A Limited. R Limited is the reporting entity. Identify the related parties for R Limited, right? So let me draw the chart. So R Limited is an associate of B Limited. So here it is R Limited. Here it is B Limited. Okay. And here it is A Limited. And here it is J Limited. Okay. So let's see who is R Limited is an associate of B Limited, right? So R is an associate, okay, of B Limited. B Limited has a subsidiary S Limited. सो ये सब्सिडरी हो गई बी लिमिटेड की, राइट। एंड अ जॉइंट वेंचर जे लिमिटेड, ये इसका जे भी हो गया बी लिमिटेड का। एंड एन एसोसिएट ए लिमिटेड, ये इसका एसोसिएट हो गया, राइट। आर लिमिटेड इज द रिपोर्टिंग एंटिटी, identify the related parties for R Limited. So for this, we need to identify the related parties. So for R Limited, B Limited is a related party, yes, because it is an associate. And S Limited is a subsidiary of an associate, is also a related party, yes. JV is a joint venture of an B, that is an associate, is also a related party, yes. So R Limited identifies B Limited, S Limited as its related parties, and J Limited, A Limited are not related parties of the R Limited. So A Limited is not related party, and J Limited is also not related party because it is a JV of the associate. So for R, only B and subsidiary S of B are the related parties. But beyond that, if there is are any associates or JV, they are not related parties, right? So this is the summary of all the related party relationships discussion we have done so far. So this is section 1, where we identify the relationships with the individuals, and this is section 2, where we identify the relationships with the entities. And these are all the clauses which we have just discussed through the examples, right? Okay. So this is one of the example which we need to understand. So parent P has a subsidiary S1, associate A1, joint control J1. Related party to P. Yes. Related party to P. Yes. Related party to P. Yes. Because this is a subsidiary. So related party, this is associate and this is joint control, joint venture. So all these are related to the parent P. Indirect control. P has a subsidiary S1. S1 has a step down subsidiary S2. So this S2 has is a related party to P. Yes. S1 in the financial statement of S1 and vice versa, indirect control, because associate of the parent is a related party to the subsidiary as well as the step down subsidiary. Clear? And then associate 2 is not related party to A2 in the financial statements of the A2 and vice versa, because A1 and A2 both are associates only, so they are not related to each other, right? Okay. Now we need to examine the related party relationships for all various entities, right? How this needs to be done for P, who all are related, for SA, who all are related, for SB, who all are related, A1, A2, and SC, and A3, right? So this is how you need to tell me which all parties you identify are related parties for all these companies, based on all the discussions we have done so far, in case you want to try at your end. Just try once. Okay. So this is the answer to this chart for P, SA subsidiary, SB subsidiary, SC subsidiary, A1 associate, A2 associate, and A3 associate. All are related parties, right? So SA, SB, A1 and A2, right? But SC and A3, out of this SC and A3, only the subsidiary, because SC is the subsidiary of SB, it is related, but step down subsidiaries associate A3 is related or not related? It's also related. So for P, SA, SB are direct subsidiaries, SC step down subsidiary, associate A1 and A2 direct associates, and A3 the indirect associate of step down subsidiary. All are related, right? All are related for P. For SA, parent P, SB fellow subsidiary, SC fellow subsidiary, A1 associate, and A2 associate. All are related, and A3 being a associate of a step down fellow subsidiary is also related, right? Similarly for SB, P, SA, SC, A1, A2, and A3. फिर SC, P, SA, SB, A1, A2, and A3, right? All are related. Now, in the individual financial statements of associate A1 and A2 and A3, P Limited is related, and the subsidiaries SA, SP, and SC are related, but they are not related to each other, right? And in P's consolidated, A1, A2, A3 are related because subsidiaries will get eliminated anyway, so they no more are there in the consolidated financial statements, right? So subsidiaries gets eliminated, only associates are left as related parties. And A1, A2, and A3 are not related to each other because of being simple associates, right? So that's what we have studied so far. With this one question, almost all important clauses, are covered. Okay, let's do this one. Whether A Limited is related to the C Limited. So X is having 100% investment in A, and X is a KMP of C, and B is having 100% investment in C. Now, what do you think? A and C are related to each other? RP? Yes. Because Mr. X is the holds the control of A Limited and is a KMP of C Limited. So A and C are related. What about this? Mr. X has control of A Limited and KMP of the parent of the C Limited. Whether A and C are related? Yes, because he is the KMP of the parent company of the reporting entity. Correct? Okay. What about this? Mr. X has joint control of A Limited and KMP of C Limited. What do you think? Yes, because again, he is a KMP of C Limited and has a joint control of A Limited. So A and C are related to each other. Yes. What about this? Mr. X has a SI here and KMP here. A and C, RP. Answer is no. Why? Because in this case, Mr. X does not have control of A Limited. It only has SI. And just by virtue of SI, it cannot be said that A Limited is a related party to the C Limited or vice versa. Right? So that's all on the related party relationships, what all are defined by the standard. Now, standard is also defining some of the relationships specifically to call out as not related parties, right? So that also we need to discuss and understand so that we do not do any mistakes while identifying, the related parties, right? So these relationships are specifically excluded from the scope of the standard, not to be treated as related parties, right? two entities are not related parties simply because they have a director in common, right? So suppose Mr. A is a director in X Limited and is also a director in Y Limited. So X and Y cannot be related to each other because just having a common director in both the companies, that doesn't mean X and Y are related to each other, right? Two venturers are not related parties simply because they share the joint control over the joint venture. So, for example, J Limited and V Limited has a common JV, right? So just by virtue of having a common JV, J and V are not related to each other, right? So this is a related, yes. This is a related, yes, but these are not related to each other, J and V. Okay. Then providers of finance, for example, banks, NBFCs, venture capitalists, etc. All these parties are simple investors of the company or providers of finance, not to be treated as related parties. Trade unions, public utilities, departments of agencies of the government that does not control, jointly control, or significant influence are not to be treated as related parties by virtue of this standard exclusion, right? So we will not say that because a particular company has financed almost 80% of the debt to a particular company, then because 80% debt is financed by one company, so that company will be regarded as a related party. No, by virtue of these financial relationships, we wouldn't be concluding those parties as a related parties. Any major customer, major supplier, major franchisor, major distributor, right? All these are not to be treated as related parties, irrespective of the fact they hold 80%, 90% volume of the purchase or sales, whatever, right? So simply by virtue of having a customer, large supplier, large franchisor, or large distributor, we cannot say these parties are related to each other unless and until there are specific, instances where we see these customer, supplier, franchisor, distributors are actually exercising their power to control the strategic policies or decision making of the reporting entity, right? So these are the summary of those relationships which are not to be treated as related parties by virtue of exclusion by this standard, right? I have just reduced whatever we have discussed in a single slide for your quick reference during your examination days. Okay. Now we have understood the related party relationships. Now we need to understand what transactions would be covered as a related party transactions and which all transactions needs to be disclosed and how, right? So what are the transactions? So transaction means a related party transaction is a transfer of resource, service, or obligation. So right, either I am transferring a resource or I am providing any goods or services or I am taking any obligations on behalf of the reporting entity. So this is covering almost all types of transactions, right, between the reporting entity and the related party, regardless of whether the price is charged or these services are provided free of cost. Okay. So it doesn't matter whether there is a price charged or not. What matters is if there is any transaction between the reporting entity and the related party. If there is any transaction, then that transaction will fall within the definition of a related party transaction and will require disclosure, irrespective of the fact what price is charged for that transaction, right? So for example, this is not the exclusive list. This is just indicative list of the transactions. There could be many more transactions, right? Purchase and sale of goods, purchase and sale of PP&D, renting of services, leases, transfer of R&D, transfer of license, transfer of finance arrangements, provisions of guarantee or collateral being provided by the holding to subsidiary or vice versa, commitments on behalf of other companies, settlement of liabilities on behalf of other companies, and management contracts for any deputation of employees between the group companies, right? So whatever is the transaction will all be falling within the definition of the related party transaction. All the transactions between the related party and the reporting entity needs to be disclosed mandatorily if there are any transactions, irrespective of the fact whether any value or price is charged by the related party or the reporting entity in those transactions or not, right? Now we will focus on disclosures because ultimate objective of the standard is to require disclosures on for related parties transactions, right? So as a step one, we have understood the scope of the standard. Then we have understood two types of relationships, one with the individual, other with the individual and entities. Then we have understood what are specifically excluded from the related party relationships, like providers of finance, trade unions, major customer, supplier, franchise, or distributor, etc. So all those parties are not to be treated as related parties. Then once we are concluded with the list of the related parties finally as per this standard, now basis on that we need to identify all the transactions which we have done with those related parties. We will formulate a list of all those transactions, and then we are on the final stage of this standard to make the disclosures around those relationships and those transactions with those related parties, right? So there are two categories of disclosures, category 1, category 2. So category 1 is the disclosure which is required even if there are no transaction with the related party. So it requires the name of the party and the nature of the relationship you have with the parties. So name of the party and the nature of relationship is mandatorily required even if you do not have any transaction during the year, right? And the second category is the disclosures for all the transactions which we have for the related parties. And this is applicable only if there are transactions, right? So first of all, we will talk about the category 1 disclosures. Here, irrespective of the fact whether there is a transaction or not with the related party, we need to disclose the details of the related party relationships. That is the name of the related party and the nature of the relationship we have with them, right? So disclose the name of its parent, and if different, the ultimate controlling party. It may be noted that ultimate controlling party may be a person, right? For example, H Limited is the holding company. H has a subsidiary, say S1. S1 has a subsidiary S2. S2 has a subsidiary S3. S3 has a subsidiary S4. Okay. Now, for S4, it needs to say S3 is my immediate parent and S2 and S2 are my intermediate parent companies and H Limited is my ultimate parent company, right? So it must disclose the name of the relationship with S3, S2, S1 and with H. So in S4 financial statement, it will disclose the related parties as S3, S2, S1 and SH, even if S4 does not have any transaction with any of these parties. So that's the category 1 disclosure. Category 1 disclosure means you need to disclose the name of the party and the nature of relationship, irrespective of the fact whether you have any transaction with them during the year or not, right? So that's the category 1 disclosure. Now, if neither the entity's parent nor the ultimate controlling party produces consolidated financial statements available for use, the name of the next most senior parent that does so shall also be disclosed, right? So in the previous example itself, if we assume that S4 is the reporting entity, which is a subsidiary of S3, S3 is a subsidiary of S2, and S2 is a subsidiary of S1, and S1 is a subsidiary of H. So ultimate parent company is H. Then only S2 Limited and S1 Limited produce CFS. Then in that case, S4 must disclose the name of the relationship with the S3, S2, S1, and H. And if S2, S3, S1, H all produce the CFS, then S4 Limited must disclose the name of the relationship with S3 and H only. That is the immediate parent and the ultimate parent. Intervening parent names can be excluded in that case, right? Any doubts? Okay. Now, disclose relationships with the parent and its all subsidiaries, right? So category 1 disclosure requires to disclose the name of the related party and the nature of relationship, right? For parent and its all subsidiaries. Now, category 2 disclosures. Disclosures are required if and only if there are related party transactions. So if there are no transactions, this disclosure doesn't apply, right? If there are transactions, then only these disclosures are required to be made. And what are these disclosures? First of all, disclose the compensation made to the KMPs in below 5 categories: short-term employee benefits, post-employment benefits, other long-term benefits, termination benefits, and the share-based payment benefits. So these are the 5 categories in which we need to make the disclosure of the compensation paid to the KMPs and other related party transactions during the year. That's here. So other related party transactions are the nature of the related party relationship and information about related party transactions and the outstanding balances. So first of all, we will disclose the transaction. For example, if we have made a sale or purchase with the related party, we will say that we have purchased the raw material worth rupees 500 crores during the year and outstanding balance at the year end is 200 crores, right? So this is how the disclosures needs to be made, right? For each transaction and for each outstanding balance with those related parties, right? And at minimum, we will be disclosing the amount of the transaction, outstanding balance of the transaction, any commitments if we have, and major terms and conditions for those transactions, guarantees if any given, and if any of the balance we have written off from the related parties. For example, we were having a debtor balance from a related party of 200 crores, but we expect 50 crores to be waived off or write off as a doubtful debt. So only 150 crore will be eventually receivable. So 50 crore will be the provision for doubtful debts needs to be disclosed as a related party, part of related party transaction, right? And expense recognized if any of the receivable amount is already written off as a bad debt. So provision as well as the amount written off as bad debt, both needs to be disclosed in the related party schedule for those related parties with whom we are recording this provision or writing it off as a bad debt. Okay. Then disclosures shall be made separately for each of the categories: the parent, the entities with the joint control, subsidiary, associate, JV, KMP, and other. So we will draw a tabular format in which, basis on these relationships, we will create a horizontal and vertical columns, and then we will start disclosing the transactions, right? And then KMPs remuneration. So this is how the disclosures needs to be made. So first of all, we say key managerial person, the name of the key managerial persons, their designation by virtue of which they are regarded as KMPs, and then from which date they have become the KMPs, right? Or if they are retired or resigned, then till which date they were KMPs, right? So this is how the KMP disclosures needs to be made about the relationships, right? And then members of the corporate management committee, etc., because all these are also regarded as KMPs, right? Chief financial officer, right? Company secretary, right? All these are KMPs. Then any relatives of the KMPs with whom we have any sort of transactions, those are to be disclosed. Then employee trust, right? So these are the provident fund, gratuity fund, pension fund, etc. All these trusts are to be disclosed as related parties. And thereafter, we will create a table like this. I have extracted it from the publicly available annual report of the ITC Limited, right? And here I will, they have created the categories, for example, where the control exists subsidiaries, then associates, then JVs, then KMPs, then relatives of KMPs, and then employee trust, right? So these are the categories of the related parties, and these are the nature of the transaction: sale of the goods and services, purchase of the goods and services, acquisition of the property, plant and equipment, sale, investment in subsidiaries, associate, remuneration, rights, entitlement, value of share-based payments, capital contribution, reimbursement, rent received, rent paid, remuneration of the managers on deputation, dividend income, dividend payments, interest income, expense, recovered expense, reimbursed, advance given, adjustments towards the refund of advance, advances received, adjustments towards advance received or refunds, deposits during the year, deposits refunded during the year, remuneration to the KMPs in the categories as we discussed: short-term, other, remuneration, stocks granted, and then outstanding balances with all these parties, like receivables, advance given, deposits given, advance taken, deposits taken, payables. And then lastly, the commitments, if there are any, which we have agreed upon, or guarantees which we have given to them, right? So this is how all these disclosures are to be presented. And then finally, the total column needs to be presented, right? And whatever we want to explain, terms and conditions specific to any of these transactions or specific to any of the related parties, we can use these legends star, hashtag, 1, 2, 3, and footnotes, and we can define whatever we want to define for the better understanding of the users of the financial statements about these disclosures, right? So this is how disclosure needs to be captured. You just have a look at your own on this disclosure table. I'm just waiting for 30 seconds so that you get to know the flavor of the required disclosures by this standard, which needs to be given in the financial statements. Right? And this is the preceding table where the nature of the relationships and the name of the related parties was disclosed. So please have a look at this slide too. Okay. So any doubts, queries regarding the nature of the relationship, identification of the relationship, or any relationship which you have in your mind, whether it should be regarded as a RP as per the standard or not, I'm happy to pick that up now. Else, I can proceed with the next. I'm just waiting for you for a minute. Okay. So if no doubts, maybe we can proceed with the next concept, that is the exemption to the government related entities. So there are certain exemptions given to the government related entities from the disclosure requirements of this related party standard, right? Although Ind AS doesn't differentiate basis on the status of the entity, but in this related party standard, there are specific discussion about the exemption given to the government related entities for certain disclosures, right? So that we will talk about quickly now, and thereafter we will conclude the session. Okay. So disclosure requirements for the government related entities. Reporting entities exempt from the disclosure requirements in relation to the related party transactions and the outstanding balance and the commitments with a government that has control, joint control, or SI over the entity, or the another entity that is related party because same government has control, joint control, or SI over both reporting entity and the other entity, right? So this is the example of this is the requirement of this standard. So if government is having a control over the reporting entity or a joint control over the reporting entity or the significant influence over the reporting entity, in that case, certain disclosure requirements are exempted. And another scenario is that another entity and the reporting entity who are related to each other are under the control, joint control, or significant influence of a government, right? Now, if the reporting entity applies this exemption, right? So again, it is an optional exemption. So if the company wants to opt for this exemption, then only they can go and opt for it. If they don't want to opt for it, they can continue with the regular disclosure requirements of the standard, right? It shall disclose the following about the transaction and the related outstanding balances. The name of the government, the nature of the government's relationship with the entity, whether it has control JC or SI over the entity, and the sufficient detail of the related party transactions, right? So this would be required in case the entity claims the exemption from the normal disclosure requirements of the standard. In that case, they will be disclosing name of the government, nature of the government relationship, and sufficient detail about the transaction which they have with the related party, right? What that sufficient detail would be? The nature and its amount. That is, whether it is a purchase or sale or PP&D transfer or rent, whatever is the nature and whatever is the amount. And for the transactions that are collectively significant, a qualitative and the quantitative indication of their extent, right? Now, how we will determine whether a particular transaction individually or collectively significant? So either it is significant in terms of size, or it is carried at non-market terms, or it is outside the normal business operations, or it is disclosed to the regulatory or supervisory body, or it is reported to the senior management, or it is subject to the shareholders' approval. So if any of these conditions are met, in that case, we will consider that transaction as a significant transaction, and because of this transaction becoming a significant transaction, additional disclosure would be required about a quantitative indication and qualitative indication of their extent of significance, right? Otherwise, only two items of disclosure are required: nature of transaction and amount of transaction. That's it. Nothing more, nothing less. Right? Is that clear? So there is an exemption to the specific entity who is having a relationship with another entity who is controlled, jointly controlled, or significantly influenced by the government. And government also has the control or joint control or significant influence over the reporting entity. In that case, this exemption is available to that reporting entity, but that exemption is optional. In case the entity wants to opt for it, they can go and opt for it and come up with the alternative disclosure requirements, right? So they will say that we have claimed the exemption from the regular disclosure requirements, and as part of that exemption, we are bound to disclose some information. Still, that information they need to make as a disclosure in their financial statements in that case. Otherwise, they can go for a regular disclosures, right? If they don't want to claim the exemption. Clear? So this is one of the example I have taken from the publicly available annual report of one of the government company, Cochin Shipyard Limited, right? So nature of transaction, what they are saying, transaction with other related parties. As Cochin Shipyard Limited is a government company under the control of the Ministry of Shipping, MOS, the company has availed exemption from the detailed disclosures prepared under Ind AS 24 with respect to the related party transactions with the government and the government related entities. However, as required under Ind AS 24, following are individually significant transactions, right? So because they are claiming exemptions, but they are required to showcase the individually significant transactions with minimum details, as we discussed, right? Transactions and balances with the government and the government related entities by the parent company, right? Now, these are the particulars, and these are the current year amounts, and these are the previous year amounts for these items, right? And what are the nature of the transactions? Secondment of employees to the subsidiary company, secondment to the subsidiary, which subsidiary they are also disclosed. Then investment in the NCDs issued by the subsidiary, investment in the NCD issued by the subsidiary, investment in the right issue issued by the subsidiary, right? So this is how they are making these disclosures by claiming the exemption from the regular disclosures. Let's do this question so that we better understand the concept. Examine exemption for the government related entities. So this is the government. Government G has a direct control over entity 1 and entity 2. Entity 1 has entity A and entity B as its subsidiaries. Entity 2 has entity C and entity D as its subsidiaries. Entity 1 has a KMP, Mr. X. Now, for entity A, if we decide this is the reporting entity, then for which all companies in this group do you think disclosures are exempt under Ind AS 24? Or exemption can be claimed from the regular disclosures? And for which party exemption is not available? So that's the question to you now. Just spend some quick 1 minute or 2 minutes on recollecting the discussion we had just now and come up with the answer. So the question here is, if entity A is the reporting entity preparing the financial statements under Ind AS, then within this group set, for which all entities, entity A can claim the exemption available under Ind AS 24 and do the minimum disclosures as required, that is the alternative disclosures, and for which entity A cannot claim that exemption. Okay, so let me discuss the solution. For entities A financial statements, the exemption of Ind AS 24 can be claimed or applies for transactions with the government G and the transactions with entities 1, entities 2, entity B, entity C, and entity D. Okay. So entity government G, entity 1, entity 2, entity B, entity C, and entity D. For all these entities and the government as well, if there are any transactions, the exemption can be claimed from the regular disclosures. But for Mr. X, this exemption cannot be claimed because Mr. X is neither the government nor the government related entity, right? So Mr. X is an individual KMP of the entity 1, and hence, if there are any transactions between Mr. X and the entity A, those are not eligible for exemption. Not eligible for exemption. Those must be disclosed. Clear? Is the concept clear? Right? Have a look at the solution again. Exemption does not apply to the transactions with person X because person X is the KMP, right? It is neither the government nor the government related entities, right? Let me move back to the concept slide. Here it is. So either the related party should be a government or it should be a government related entity. Then only exemption applies. So in our chart, government is government G, so exemption applies. Government controls entity 1, so exemption applies. Government controls entity 2, so exemption applies. Entity 1 controls entity B, so exemption applies. Entity 2 controls entity C, so exemption applies. Entity 2 controls entity D, so exemption applies. So because all these entities are either the government or the government related entities, so any transaction between the entity A with these entities, right, that can be eligible for the exemption under Ind AS 24. But any transaction between the entity A and Mr. X, who is the KMP of entity 1, is not eligible for exemption. Clear? Okay. So that was it from my side on this standard. I hope the session standard was informative. Now I will touch base on the key differences between the Ind AS and the IGAP, right? Because we have been using the AS 18 under our IGAP financials, and we must have been preparing, related party disclosures and identifying the related parties under the AS 18 as well. So I am just, talking about the key differences between the two standards so that we better understand what all is new under the Ind AS as compared to the IGAP. So first of all, the definition of a relative. So under Ind AS 24, definition uses the term a close member of the family of a person, and definition of the close members is defined to include as person's children, then person's spouse, and the person's domestic partner. So this is new, right? Then children of that person's spouse, this is new, right? Or that domestic partner, this is again new, right? So these are the new people who are to be treated as close family member, and in turn the related parties, and then dependents of that person and that person's spouse or the domestic partner. So domestic partner dependents are also covered. Hence, the Ind AS 24 has a wider set of people who would be treated as related parties by virtue of being close family member of the KMP. But under AS 18, it uses the term relatives of the individual. So the term here under Ind AS is a close family member, or the term under AS 18 is the relatives of an individual. Now AS 18 covers spouse, son, daughter, brother, sister, father, and mother, right? But under Ind AS, it is also covering domestic partner and dependents of domestic partner and children of domestic partner, if different from the person, right? So domestic partner may have the children with other person as well, right? So those children are also covered under Ind AS 24, but AS 18 doesn't, cover all those relationships or all those people as a relative of the individual, right? So that is altogether extended family of the individual, right? Which is covered under Ind AS. Then related parties in case of joint venture. So under AS 18, co-venturers or co-associates are not related to each other, right? But under Ind AS 24, co-venturers are covered, although co-associates are not related. So co-associates will remain to be unrelated under Ind AS 24 as well, but co-venturers will be covered, right? Then Ind AS 24 brought in with the concept of including the post-employment benefit plans, right, to be covered as related parties. If you notice this in this disclosure, here it is. Post-employment benefit plan. So all these trusts are covered as a related parties in the related party disclosures, right? This was not required by AS 18, right? So this is altogether new item. So any trust which is set up by the company for the benefit of the employees, for example, provident fund trust, gratuity trust, pension trust, employee stock option plan trust, etc., 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 All these are to be treated as a related party and needs to be included in the related party disclosures under Ind AS balance sheet. But in IGAP balance sheet, there was no such requirement, right? So not specifically covered by ASAT. Then disclosure of the compensation, right? So KMP's disclosure is also required. If you notice in this disclosure, here it is, key managerial person, and uh, 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 here it is the disclosure, right? Short-term benefits, other remuneration, stock options granted to the KMPs. All these disclosures are required, right? But under AS 18, this disclosure is not specifically required, right? So that is again the new thing. So a lot of additions have happened under Ind AS 24 as compared to the corresponding standard in IGAP AS 18 in terms of the nature of the relationship. So wider pool of related parties and additional disclosures as well, right? Next, more senior parent. So Ind AS 24 requires an additional disclosure as to the name of the next most senior parent which produces CFS. AS 18 has no such requirement, right? And then KMP. Ind AS 24 covers KMP of the parent as well. It covers KMP of the reporting entity only, right? So if AS 18 is being applied, KMP of the parent company will not be covered as a related party. But if Ind AS 24 is being applied while preparing the Ind AS financials, then KMP of the parent company as well needs to be included in the related party disclosures. Then government controlled enterprises. So Ind AS 24, there is a extended coverage of the government entities as it defines government related entities as an entity that is controlled, jointly controlled, or significantly influenced by the government, right? AS 18 defines state controlled enterprise as an entity which is under the control of the government or any state government, right? So wider definition or extended coverage has been done under Ind AS 24 as compared to the AS 18, because AS 18 only talks about the entities controlled by the central government and the state government. But Ind AS 24 talks about entities covered, controlled, jointly controlled, or even significantly influenced, right? So under AS 18, SI is not covered, but under Ind AS 24, SI is also covered. So if government has 20% stake in any company, that is the significant influence in that company, then that company is also covered for this exemption, right? And government definition itself is a wider. Government refers to the government agencies and similar bodies, whether local, national, or international. And here only state government and central government, SG and CG, are covered. Here international government is also covered, right? Government bodies are also covered. Government agencies are also covered, but that is not the case with AS 18, right? So wider definition of the government and extended coverage of the government control, that is control, joint control, and SI, all are covered. But under AS 18, only control is covered, right? Government related entities. Ind AS 24 requires disclosure of certain information by the government related entities. That is, exemption is given, but still certain information is required. AS 18 completely exempts the disclosure, right? So Ind AS 24 provides some exemption, but asks for certain disclosure. AS 18 completely exempts the government entities from the disclosure requirements, right? So that is again the key difference. So that was it on the key differences. If you have any doubts or queries on this, please do ask me. I am happy to take your queries. Okay. So if no queries, maybe we can quickly try on some of the multiple choice questions, and then probably we will conclude a summary of the discussion we have done on the related party and wind up the session thereafter. Okay. So first MCQ, an entity that has a common director with the entity is not required to make minimum disclosures prescribed under Ind AS 24. What do you think? True or false? True, because the entity that has a common director with the entity is not required to make minimum disclosure because common director doesn't qualify for a relationship, right? So, for example, A Limited and B Limited and Mr. X is the common director in both the companies. So, A and B are related party, yes or no? No. So, A and B are not related to each other, hence no disclosure required. Ind AS 24 requires disclosure for the compensation of the KMP. In which of the following would not be considered as compensation for this purpose? Short term, share based, termination, or reimbursement of out of pocket expenses. What do you think? Which item is not to be considered as a compensation to the KMP for the purpose of disclosure under Ind AS 24? Reimbursement of out of pocket expenses. This is not the category which is required by the standard. Let's go back to the concept slide to crystallize this once. So these are the five categories where the disclosures are required. So if there are any KMPs, then for those KMPs, I need to disclose short-term employee benefits, post-employment benefits, other long-term benefits, termination benefits, and the share-based payments, right? So out-of-pocket expense reimbursement is not the category given by the standard. Hence, that is not required, right? So that is the MCQ asking for, right? So reimbursement of out-of-pocket expenses is not the category required by the Ind AS 24 to be disclosed, right? Which of the following statements related to the disclosures under Ind AS 24 related parties are true? The standard requires disclosure of the compensation of the KMP who are working in an executive capacity only. The measurement of the transaction between the related parties shall be at fair value. Parties having joint control over the reporting entity and the joint ventures in which the reporting entity is a venturer are covered by this standard, or the two venturers are not related simply because they share the joint control over a joint venture. Now, which of the following statements relating to the disclosures under Ind AS 24 parties related parties are true? Which statements are true? So options are A, B, C are true, A, C, D are true, A, B, D are true, or C, D are true. So you need to tell me A, 1, 2, 3, or 4. Just read the question carefully. Try to recollect whatever we have discussed so far. Apply that knowledge and come up with the answer. So option 4 is correct. That is statement C and statement D are true and statement A and statement D are false, right? So let's revisit. The standard requires disclosure of the compensation of the KMP who are working in executive capacity only, right? So this statement is false. Why? Because executive director as well as non-executive director both are required or covered as related parties by the standards, right? So this statement is saying only executive director. So statement is false. A is false. The measurement of the transactions between the related parties shall be at the fair value. So we have not talked about, or standard has not mentioned anything about the value of the transaction, right? So there is no requirement casted by the standard that this transaction has to happen at the fair value. Hence, this statement is also false, right? Statement C, parties having joint control over the reporting entity and the joint venturers in which the reporting entity is a venturer are covered by this standard. So that is the one of the relationship that we have already covered. So if the parties have the joint control over the reporting entity and the joint venture, then those parties are related to each other, right? And two venturers are not related parties simply because they share joint control over a joint venture. So that we have already covered. So this statement is true. So both these statements are true and both these statements are false. Next, which of the following event would require disclosure in the financial statements of the RP Group, a public limited company under Ind AS 24 related party disclosures? The retirement benefit scheme of the group is managed by another merchant bank. An investment manager of the group retirement benefit scheme is also a non-executive director of the RP Group and received an annual fee of for his services of 2.5 lakh, which is not material in the group context. The company pays 16 crores per annum into the scheme and occasionally transfers assets into the scheme. In 2014, property, plant, and equipment of rupees 10 crores were also transferred into the scheme and a recharge of the administrative cost of 30 lakh was made. The contributions paid, the non-current asset transfer of rupees 10 crore and the charge of administrative cost 30 lakhs, the contributions paid, the non-current assets transfer of 10 crore and the manager's fees of 2.5 lakhs are the manager's fees 2.5 lakhs and the charge of administrative 30 lakhs or all of the above. What do you think? Which of the following would require disclosure? What do you think? A, B, C, or D? Just try this once, note down your answer, and then when I will be discussing this answer, you can match yours. Option D, all of the above. So all the transactions would be required as part of the disclosure of Ind AS 24 because all the contributions made, non-current asset transferred, administrative charge, or the manager's fees. It doesn't matter whether the amount is material or immaterial from the group perspective. Whatever is, if the transaction needs to be disclosed. When we are going to disclose the transactions, we cannot say that we will disclose only material transactions. We have to disclose every transaction with the related party, right? So this is the answer for this MCQ, just for your reference. Employee retirement benefit scheme of the reporting entity are included in the Ind AS 24 definition of the related parties. The contributions paid, the non-current asset transfer, and the charge of administrative costs must be disclosed, right? The pension investment manager would not normally be considered as a related party. However, the manager is the key managerial person by virtue of his non-executive directorship. Hence, directors are deemed to be related parties by Ind AS 24. So the manager who is receiving 2.5 lakh as a fees, Ind AS 24 requires the disclosure of the compensation paid to the KMP as well. And hence this fees falls within the definition of the compensation to the KMPs. Therefore, this needs to be disclosed. So that's the answer. Okay. Ind AS 24 requires reporting entity to disclose relationships dash irrespective of whether there have been transactions with them. So with its suppliers and customers, between parent and subsidiaries, with the government, or between the associates of one group. What do you think? What should be the appropriate word for the fill in the blanks? So Ind AS 24 requires reporting entity to disclose relationships. That is the category 1 disclosure. Right? Category 1 disclosure says disclose the name of the related party and the nature of relationship mandatorily, whether there is transaction or not, right? So for category 1, uh, relationships between the parents and the subsidiaries are applicable, right? Intra-group related party transactions and the outstanding balances are dash except for those between an investment entity and its subsidiaries measured at fair value through the profit and loss in the preparation of the CFS, consolidated financial statements of the group. De-recognized, eliminated, presented separately, or disclosed. What should be the appropriate word for the fill in the blanks? Eliminated. So what we do whenever we prepare the consolidated financial statements, so intra-group transactions and balances gets eliminated, right? So appropriate word is eliminated. A related party transaction is a transfer of resource, service, or obligation between a reporting entity and the related party dash unless the market price is charged. When no price is charged, regardless of whether the price is charged or at a price that is lower than the current market price. What do you think? What is the right appropriate word over here? Regardless of whether the price is charged. So disclosures are applicable irrespective of the fact whether the price is charged or not, right? Statement 1. In considering each possible related party relationship, attention is directed to the substance of the relationship and not merely the legal form. Statement 2. Two entities that have the director or other KMP person in common or a member of the KMP personnel of another entity has significant influence over the other entity are related parties. Which statements are true? Both statements are true. First is true, second is false. Both are first is false, second is true, or both are false. A, B, C, D. Option B. First statement is true. That is, in considering each possible related party relationship, attention is directed to the substance of the relationship, right? What is the substance of the relationship, not merely the legal form. And statement two entities having the common director are not related to each other, right? So they cannot be related. So hence the statement is false. Entity Z has a control over entities A, B, and C, and has a significant influence over entities D and E. Entity C has significant influence over entity F in a separate financial statements of entity Z. Which of the following is not related party? So Z has A, B, C has control, and Z has significant influence over D and E. Significant influence over E. Now, entity C has a significant influence over entity F, right? In the separate financial statements of entity Z. So, entity Z is the reporting entity. Which of the following is not a related party? So, D is not related, E is not related, or F is not related, or none. What do you think? Which one is not related? None. So all are related, right? So for Z, all are related parties. Clear? Why so? A is subsidiary related, B is subsidiary related, C is subsidiary related, D is significant influence, that is associate related, E is significant influence, that is associate related, and F is an associate of a subsidiary. So associate of subsidiary is also related. Entity Z has a control of entity A, B, C, and has significant influence over entity D, and C has significant influence over entity F. In the financial statements of entity A, which of the following is not a related party? Now, in the same chart, for entity A, now we need to assess. So, on entity A के लिए entity F is not related because F is a associate of a subsidiary, right? So, associate of subsidiary is not related to the fellow subsidiary companies. Okay. And if we decide this for in the financial statements of D, who is the related party? For D, who is the related party in the same chart? So entity Z is the related party. Let me draw the chart here quickly. Entity Z controls A, B, and C, right? C, control. And D, it has SI, right? And E also, it has SI, right? Entity C has significant influence over entity F, right? SI. In the financial statements of D, who is the related party? So for D, Z is the related party, right? Because D is the associate of Z, so Z is the related party for D. Now, in the same chart, for entity, in the consolidated financial statement of entity Z, who is not the related party? Who is not the related party? So again, the same chart. Now, instead of separate financial, for Z's consolidated financial, who is not the related party? He is not the related party. Why? Because in the consolidated financials of Z, so A, B, and C, because all these are the companies who are eventually being consolidated and the transactions and the balances will get eliminated, right? So they will no more be disclosed as the related parties. So that was it from my side on this standard. And I hope the session was informative and helpful for you. I wish you all the very best for your CA final examination. With that note, I conclude this session. I'm happy to take any queries if you have any. Otherwise, I will log off after waiting for 30 seconds if you respond with any queries. Okay. So I think we can close the session. And thanks everyone for listening me patiently. Have a good day. Bye. Yes, session is over. Thank you. Same to you.